Tax loss harvesting. How to turn this year's market losses into tax savings. Right now, 55% of S&P 500 stocks are sitting at a loss for the year. If you own any of them in a taxable brokerage account, those losses are not just bad news, they are a tax asset, and most investors never touch them. This strategy is called tax loss harvesting. It's one of the few legal moves that lets you lower your tax bill without changing your long-term investment plan. Professional asset managers harvested nearly $4 billion in losses for their clients in the first quarter of 2026 alone. Institutions do this constantly. Most individual investors don't know it exists. In this video, I'm going to show you exactly how tax loss harvesting works, how to avoid the one rule that trips most people up, and how to run through this in your own portfolio today with real numbers. No complicated tax code, no jargon. Let's get into it. Let's start with the basic mechanics, because there's a lot of confusion about what tax loss harvesting actually does and what it doesn't. When you own an investment that's gone down in value, that loss exists on paper, but it has no tax consequence until you sell. The IRS doesn't care about unrealized losses. The moment you sell, it becomes a realized loss, and now you can use it. Here's how you use it. If you have realized capital gains somewhere else in your portfolio, say you sold a position that went up, your realized loss directly offsets those gains, dollar for dollar. If you harvested a $5,000 loss and you had $5,000 in gains, those gains are wiped out. Zero capital gains tax. If your losses exceed your gains, there's still a benefit. You can deduct up to $3,000 of net capital losses against your ordinary income each year. That means if you have $8,000 in losses and no gains, you deduct $3,000 from your taxable income this year, and the remaining $5,000 carries forward to next year indefinitely until it's used up. No expiration, no limit on how many years it carries forward. The reason this strategy is particularly relevant right now is that 2026 has given investors an unusually large inventory of losses to work with. The S&P 500 is down about 4% year-to-date as of April, but that headline number understates what's happening underneath. 55% of individual S&P 500 stocks are in the red for the year, with an average decline of nearly 13% among the losers. Tariff uncertainty, Fed policy confusion, and sector rotation have created broad damage, not a clean correction that took everything down equally. For investors with diversified portfolios, there are probably positions in tech, consumer discretionary, or international exposure that are sitting on significant unrealized losses right now. And this isn't just a year-end game. You don't have to wait until December to harvest. Harvesting in April means you're locking in the tax benefit early in the year, with 9 months of clarity before year-end. If the market recovers from here, you'll be glad you harvested when the losses were available, and you'll still participate in the recovery through the replacement position. Professional managers harvest continuously. The best time to harvest is when the losses exist. Right now, they exist. Let me run through real numbers so you can see exactly what this is worth. Assume you're in the 22% ordinary income bracket and the 15% long-term capital gains bracket. This describes most middle-class investors. Earlier in the year, you sold a position for a $5,000 long-term gain. That gain would normally cost you $750 in capital gains tax, 15% of $5,000. Now it's April. You have 3 positions in your portfolio that are sitting on losses. Combined unrealized loss, $8,000. You sell all 3. You've now realized an $8,000 loss, and you're still invested in the market. That's the key. You didn't go to cash. You swapped the losing positions into similar but different holdings, so you're still participating in any recovery. We'll walk through exactly how that swap works in a minute. Now for the rule that trips up nearly every first-time harvester. It's called the wash sale rule, and if you don't understand it, you can harvest a loss and have the IRS disallow the entire deduction. Here's the rule: if you sell a security at a loss and buy back a substantially identical security within 30 days, either before or after the sale, the loss is disallowed. The IRS treats it as if the sale never happened. What does substantially identical mean? The rule is strict for the exact same stock, the exact same ETF, the exact same mutual fund, or options on the same security. If you sell Apple stock and buy it back the next day, that's a wash sale. If you sell a Vanguard S&P 500 fund and buy the exact same fund back 2 weeks later, that's a wash sale. But here's where harvesting actually works. You can immediately reinvest in a similar but different position without triggering the rule. Sell the Vanguard S&P 500 ETF, VOOO. Immediately buy the Vanguard Total Stock Market ETF, VTI. Different index, different holdings, different fund. The wash sale rule is satisfied. You've harvested your loss, and you're still invested in the broad US market, starting that same afternoon. Or sell an individual stock, say a semiconductor company that's down, and immediately buy a technology sector ETF. Not a wash sale. You kept your market exposure, you just converted a single stock position into sector exposure for 30 days. The ETF swap is the mechanism that makes tax loss harvesting practical. Without it, you'd have to sit in cash for 30 days to avoid the wash sale rule, and you'd miss out if the market recovered during that window. The swap solves this. You sell the losing position and immediately purchase a replacement that tracks a similar market segment but is not the same fund. You're never out of the market, you just hold a slightly different vehicle for 30 days, then optionally swap back. Let me give you the most common swap pairs. If you own SPY, the Spider S&P 500 ETF, and it's down, you could sell it and immediately buy VTI, the Vanguard Total Stock Market ETF. VTI holds all US stocks, including small and mid caps, not just the S&P 500. Different index, completely safe for wash sale purposes. If you own QQQ, the Nasdaq 100 ETF, and want to harvest a loss, consider swapping into VGT, the Vanguard Information Technology ETF. Different methodology, different holdings, but similar tech exposure. If you own individual stock positions, a company in your portfolio that's down 15%, you can sell the stock and buy its sector ETF. That's always a clean swap. An individual stock and a diversified fund are clearly not substantially identical. After 30 days, you can swap back to your original fund if you prefer it, or just hold the replacement. Both are valid. Before you go execute this in your portfolio, here are the 5 mistakes that erase most of the benefit. These aren't complicated rules, but missing any one of them can negate the entire benefit. Here's the exact process. 7 steps. That's the entire process. It takes maybe 30 to 60 minutes if you've never done it before. After the first time, it takes 15 minutes. Market down years are frustrating. But the one silver lining, and it's a real one, is that losses in your portfolio are a tax asset waiting to be harvested. Most investors walk past that asset every single year without touching it. If you want to go deeper on tax strategy for retirement, the Roth Conversion Ladder video covers a connected idea: how to convert tax-deferred savings into tax-free income before retirement. It links directly to everything we talked about today on managing your tax bracket. That video is right here. If this was useful, subscribe. We publish this kind of breakdown every week. See you in the next one.